Well, welcome to Voc Talk. I'd like to introduce my guest and friend, Karl Pickler, to the show. Karl, for viewers who are not familiar with your illustrious career, can you please tell us a little bit about yourself and what brought you to San Antonio?
Sure. I'm originally from Switzerland, born and raised there. Studied business and finance, and then had an opportunity to join a consulting firm in New York, which I did in just about 2000. So I moved to New York in 2000, lived there for 5-6 years, and then Rackspace, which is a San Antonio company, they were a client of mine. So I joined them in 2004 as a consultant, and in 2005 full-time, and then we moved down here. I was originally head of finance for the company for the first couple of years. We took the company public. I went after that to London to become the regional CFO of the business, which basically was everything outside of the US. And then in 2011, I was promoted to CFO of the company, and we came back to San Antonio and are here since then.
Wow, that's amazing. To be at the almost ground up level, right? Was Rackspace still pretty much in its initial growth stage at that time, or was it, would you say, more of a mature company at that time?
No, very much growth. So I joined the company when we were 400 people and had about $80 million in revenue. And then by the time we left, or by the time I left, we were $2 billion in revenue and 6,000 people. So it was growing every single month, every single quarter, every single day almost.
So, and for those viewers that may not know or are familiar with Rackspace, what was the primary business model for Rackspace?
Rackspace was what we would call a technology-enabled service company. So we ran data centers for our customers, and in those data centers we built up dedicated infrastructure for our customers. So what that means is, when you run an application or a website, generally speaking, you need to host that somewhere. You have to put it on a server, and you have to have storage for your database, and you have to have connectivity so that the server is connected to the internet. All of that requires quite a bit of expertise to do. And so we did that. Some people would call this an infrastructure as a service business. We hosted everything. We owned the building, we made it a data center, we put in the infrastructure, and then ultimately we provide credentials to our customers so they can do with their infrastructure whatever they want, whether it's an application or a website or whatnot. So we were what people would sometimes call the slow cloud. We were the cloud before the cloud existed, and we did it in a people-enabled way. We were very service-oriented, we were customer-focused, and ultimately the technology became the cloud, and the cloud was basic. The main difference was that the cloud was doing all of what we did in a very programmatically software-enabled way.
I see. Okay. And Rackspace was really hardware-driven, essentially. I mean, you had the servers and right. Okay. Yeah. That's incredible. All right. Well, I'm gonna throw a hard question at you first. All right. So, are you predominantly a coffee drinker in the morning or a tea drinker, or you don't like to be categorized by what you drink?
Coffee, definitely coffee. Yes, that's the first thing I do. I turn on the coffee machine. I also drink tea, but definitely in the morning is coffee. Yes.
That's fantastic. I'm a tea drinker, so I love my tea. I'm similar. I usually put on the hot water right in the morning and then start my day after a nice cup of hot tea. Now that we've got the tough stuff out of the way, I'd like to know what drew you into the investment world. In addition to already having background and experiences as head of finance for Rackspace and then CFO for the company, what actually brought you back into the investment world, and where did that passion come from?
Yeah, so I would say it's passion and necessity, right? Everybody in their lives becomes an investor, voluntarily or involuntarily. We all have to save for retirement, and to the degree to which we apply ourselves to that work is obviously varies across people. But I'm a student of business. I'm passionate about business, and investing is kind of the all-encompassing task, right? Where it's like, if you really want to think about your investments in a more engaged way, in a more active way, if you want, then you really have to think about all of the business aspects of a company. You have to think about their strategy, their industry, their competitive positioning, their financials, what's already priced into the stock and whatnot. And it's just a fascinating, really all-encompassing activity to when you really think about business.
Sure.
I'm not really a professional investor in the sense that I don't really manage other people's money. I just do it with my own.
Sure. Well, but you have some other ties to investments as well. You're currently the Prassel Professor of Professional Practices in Finance at Trinity University.
Yep.
I've tried saying that like 4 times really fast. There's a lot of P's in that title.
Yeah.
And by the way, go Tigers. So Tiger alum, and Rackspace was also originally started by Trinity alum.
That's correct.
And so a lot of Tiger power here. And right now you also oversee the student managed fund at Trinity University. So aside from your teaching roles in some of the courses in finance that you teach the students, tell us a little bit more about what the student managed fund is, and then what your role or capacity is as the person who oversees that student managed fund.
Okay. So the student managed fund was started in, I want to say, 1998 or something like that by Professor Cooley. It was like many other student funds across the nation. It was a small contribution from the university's endowment that started it. And the whole purpose was for students to really make not only simulations and think about companies, but actually make investment decisions with real money that is part of the university's endowment. That fund grew over the last 24 years or so to now $10 million. So
wow.
We're just about $10 million, a little bit up and down. Last year was a bad year.
All organic growth, or were there additional contributions made by the university?
Some contributions made, but I think the total contributions were less than $1 million.
Wow.
I think in total. And so, we had a good period over the last 20 years in general. So now it's a $10 million fund-ish, and the students get to run that money for a year. So it's a 2-semester class. They have a couple of prereqs, but one specific prereq is a course called Equity Valuation that we newly designed, which is the first class where students really learn how to analyze a business and write a research report and value a company and think about what's priced in and whatnot. And so they take that course first, and then when they come to SMF, they inherit the portfolio from the previous class. So deliberately, we don't clear it. Usually, when you're in a work environment, you always inherit something. Right. You never start with a clean sheet, and so they are inheriting previous classes' portfolio. And then there's basically the same work in different variations. They have to cover the companies that they inherit. And they have to work on new ideas. And so there's various goals from a learning perspective. It's about writing reports, it's about presenting, it's about researching companies, it's about understanding strategy, it's about articulating competitive position and valuation approaches. All of these things come together. So it's not formally the capstone class, but it is considered a capstone class because it brings everything together. The students run it entirely autonomously. I'm their guide. I'm the risk control person there. I need to ensure certain levels of diversification. I need to make sure that decisions are substantiated and supported. It's all voted, so it's like a democratic process of what gets in and what gets sold. I'm just there to basically guide and control. I have a veto right. I've never used it in 4 years. And I let the students do whatever they want to do, as long as it makes sense.
So I was going to ask about that. I was going to say, are you kind of like the president of the United States where you can say, I veto this idea and just completely...
I can't.
Okay.
I've never done it.
Okay, great. Well, I guess, in thinking about the investments in the student-run portfolio, one of the questions that I had in mind was, is there just a single way to value a company? Or how do your students value the positions and determine what they want to bring into the portfolio, which really kind of I'm leading to what is your buy-side decision-making process and then your sell-side decision-making process. And so that's really where I'm heading with these questions. Is there really just one way, or do you only teach one way of evaluating a company, and then how do the students decide what to get rid of from the portfolio and then what to add to the portfolio?
Yeah, very good question. That's the $1 million question, investing. So from a approach perspective, the way that we've set it up is that every company has to be valued with a traditional DCF approach. Okay, so
oh, and for viewers who may not know, DCF is a discounted cash flow approach.
Right. So the students have to, analyze the history of the company, analyze the financials, think about what the margin profile looks like, think about what revenue dynamics look like. Is the company growing or not? Based on that, they have to form a reasonable set of expectations about the future. But the first exercise really is what we call the base case, and the base case, which is a little bit different than what normally people would refer that to, is not the student's best estimate, but the base case is basically what the market says today. So they are modeling out future cash flows that equate to the current price.
Sure.
And that answers, obviously there's a million variation on how you get to the current price, but that answers the question of what's priced in. And that's the core of the debate, which is like when we have a position that we're considering buying or a position that we haven't considered selling or holding or upping, is that what's priced in, and do we feel that the growth expectations that are already reflected in the price are higher or lower than what we can reasonably think this company is able to do.
Sure.
And that's what the discussion is really all about. The bull case and the bear case variations are those discussions then that happen, which is like what can go wrong and what has to be right and what do we have to believe in for this to be a really good investment. Because as we all know, good companies are not necessarily good investments, and so.
And what do you mean by that? Because that's a really important part of market psychology that a lot of people really don't understand.
Yes.
You made a great comment. Good companies are not necessarily good investments.
Yes. So most people that are non-professional investors make that step very quickly, which is like, this is an awesome company that does these cups, right? Where you can basically temperature control your cup and it never gets cold, never gets hot.
Oh yeah, the Ember.
The Ember, it's great, right? And so this must be an awesome company, so I want to invest in that stock, right? But the problem is that if you have, everybody believes that this is a great company and everybody piles into that stock, then the price will eventually be high enough for it to not be a great investment, meaning that all the future Ember cups that will be sold and the profits they're going to make are already capitalized in today's price. And we have that problem, we've had that problem over the last 10 years pretty much because we had such a strong market that every company was just very expensive. Mm-hmm. And especially the good ones are very, very expensive. And you want to find good companies at a low price.
Sure.
that is the trick, I guess, about investing. And usually good companies are trading at very high prices.
Absolutely. And in the industry, you often hear terms like growth at a reasonable price, or yes. Value managers looking for stocks that are not value traps, but actually have value relative to their future cash flows or earnings based on their current price. So there's room for growth.
That's
and
right.
For investors who are maybe new to the industry or are learning about investments, oftentimes, for example, wealth managers or investors will look at one of those ratios known as price to earnings, or the PE ratio.
Yep.
And is that something that you also do? Do you all look at kind of the ratios and look at, when you're assessing kind of where the company is in its cycle and relative to its potential future earnings and cash flow? Are you looking at some of these ratios?
Absolutely.
Okay.
Yes, absolutely. I mean, the price earnings ratio is a shortcut ratio for what's priced in.
Correct.
Right? And so if you have a high PE stock, it simply means that a lot of future earnings have already been capitalized into the price, and in order for this to be a good investment, the company has to outperform those expectations and grow even faster, or grow profits even faster, which is something that you need to build conviction around if you want to invest in that company.
And so one that comes right to mind, which is a hot topic of debate, and you probably know which one I'm about to spring on you. But there's a lot of debate as to what the correct valuation or the right PE multiple is for Tesla. Tesla happens to be a highly debatable stock because if you looked about a year and a half ago, 2 years even,
Yep.
you know, the PE multiples were just outrageous. I mean, I think it was in excess of, you know, like 80 to 90, maybe even over 100 at one point in the last few years. And so you have to, but at the same time, the stock has done quite well, you know, over the years. It's had a tremendous amount of growth. You know, so how do you really like figure out, you know, what that PE is trying to tell you, and is it reasonable to go by that? You know, sometimes you might have to hold your nose and just buy the company because the market really hasn't factored it in one way or the other. What are your thoughts on that? Specifically, what are your thoughts on, you know, Tesla's PE? You know, is it too high? Is it too low?
Yeah, so I'm a big fan. Let me put that first. So I'm a little bit biased, but we have looked at Tesla in various classes. It is part of the fund. We have it in the portfolio. And we talked about Tesla extensively as a case study in various classes. So we've spent a lot of time. I personally think it's one of the, probably, if not the best, one of the best companies ever created.
And why do you think that?
I just think that a lot of the things that they do differently is just going to be so disruptive for the existing industry. The degree of vertical integration that allows them to iterate much faster, the focus on manufacturing scale. I mean, they have the largest factories already now. The long-term bets that they've made, which you know, one example is the supercharging network, which, you know, in the beginning nobody was building EVs because you didn't have a supercharging network, and you know, Musk is a person that has demonstrated many times that he has a 10, 20, 50, 100-year vision when he starts building companies, and he's done it numerous times now. And you need somebody like him to really shake up an industry or re-kick an industry in the context of the cars. And you know, without him, we still would not have any EVs. I mean, the incumbents didn't do anything over the last 20 or 30 years because it was always this chicken and egg with like, well, we have an existing business that's doing quite well. We have a supercharging network, the gas stations, which are everywhere, right? So why would we start thinking about doing something else? And it needed somebody like him and the startup really to shake up that industry. And it's just amazing to see. Like, if you look at any company, if you look at how Amazon grew in the first 10 years, if you look at how Apple grew over the first 10 years, which was a very rocky path at the beginning, but all of the most you know, successful companies that were started in the last 20 years, I think there are very few that are comparable to them, and they have huge opportunities that are, but going back to your question, so why is their PE so high? Well, you know, there's always this debate, is it a car company or not? And of course, it is a car company on one hand. They build cars, I do have a Tesla, they build fairly awesome cars, I think. It's a very large market. It's obviously questionable as to what size or what share of the market they will be able to capture and how quickly the competition is going to catch up and to what extent. But even if you think about that, you know, which company will really be able to build electric cars at the scale that Tesla does? And it's likely that nobody will be able to catch up.
And not just in terms of manufacturing. I mean, we think car company, I mean, we think just the nuts and bolts, but I mean, Tesla's far more than that. I mean, it's a software company.
Exactly.
They were one of the initial, I would say, pioneers before all of the recent trend around like this AI, et cetera.
Yep.
I mean, they were already kind of developing that technology in terms of like self-parking cars, self-driving cars.
Yep.
I mean, so you really think of it, it's not just, to me, it's kind of like Apple. You know, Apple integrated both the software and the hardware together.
Yep.
And you know, Elon Musk has done similar. Like Tesla, to me, is just not a nuts and bolts manufacturing car company. I mean, it's much more than that.
And that's what drives the multiple up, right? Because they have so much optionality, as people would call it, that they have an insurance business, which is very interesting. They have a supercharging network. They can now open up and generate, you know, money on that. They have
the batteries.
They have the battery business. They will probably likely endeavor into mining, or at least they've said that many times. They have the self-driving thing, which, you know, Elon Musk has promised to be final and ready every year for the last 10 years, and it's not done yet. And he has openly said that this is the hardest problem, harder than landing rockets. It's a very, very difficult problem to solve. But again, if there's anyone who's going to solve it, it's them.
Sure.
Right? And maybe it's going to take
Sure,
another
yeah.
10 years. Who knows? But this is what also drives the volatility of the stock, which is that, you know, sometimes people lose faith in his promises, and you know, if the self-driving technology and the commercial opportunities associated with it are so large that if you believe that the likelihood is high it's coming soon, the valuation has to, you know, properly reflect that.
Yes.
And if the belief goes away, then, you know, the stock can collapse very quickly.
Sure.
And that's, I think, what we see in a company like this, that even though the prospects are fantastic, the volatility around it is very high.
Of course, and oftentimes that volatility, for some of our viewers who may not be familiar with the company, a lot of that volatility also is around what Musk is doing with some of his other businesses, et cetera. There's, you know, the whole Twitter issue in the past year, et cetera. But you know, I really think it's a game changer. It's a technology that he's really pushed as a pioneer and brought to the forefront, and now everyone else is starting to follow that trend and that model. So thanks. I think that's wonderful insight in responding to those questions, kind of about, you know, valuations and PE multiples for companies such as Tesla. As another question for your fund, how do you all think about risk for your fund? And so, you know, for example, what's the largest size position you might take in a particular company? And then secondly, what do you benchmark to?
Yeah. Okay, so we basically have two parts to the portfolio. We spend the first month or the first maybe 3 weeks of the first class, so the first semester, talking about passive investing, which is, you know, an index approach to investing where you don't try to figure out what stocks to pick and what sectors to weigh on, but simply I'm going to buy the entire market. And I do it in a very cost-effective way, and I don't trade, right? So there's a couple of variations on this, what it's called indexing or buy and hold. But the whole idea is that you contribute to your portfolio in a somewhat a continuous and regular way. You never really sell. You don't really try to time the market. You don't try to find the next Tesla. You just buy the index and you accumulate your portfolio that way.
Sure.
Right? And I would say for 99% of non-professionals, that's the way that probably investing should be done. And then, you know, because it takes a lot of expertise, time, and experience to be successful at you know, beating the market. And academically, at least, the track record of active investing is you know, questionable, at least. Anyways, so we spend a little bit of time on that, and that creates a core in our portfolio. So we have about 50% of our portfolio is allocated to a 3-index fund, Boglehead portfolio.
Sure.
Which is basically, we own a US index fund for US equity, we own an international non-US equity fund, and then we own a little bit of bonds.
Okay.
And not that that is any way interesting or very full of insights, but it's just a very standard way of creating a passive portfolio. And so what we do is whenever we have an active position, so when we want to pick a specific stock, we're going to sell part of the index funds, buy that position, and when we sell, we do the opposite.
Okay.
So we have no cash,
Okay.
zero cash.
So you're always invested.
We're always fully invested.
And are those your three primary, well, really it's 2 asset classes. You've got equities, domestic, international,
Yeah.
and then bonds.
And then bonds, and that's it.
Got it, okay.
That's it. And so we spend a little bit of time on talking about that, and then that's done because there is not much to talk about. Passive investing is fairly easy, and then we spend the rest of the time, you know, trying to find stocks that we believe are undervalued ultimately. So the benchmark is technically the S&P 500, which is the 500 largest stocks in the United States. We've had a couple of conversations. The benchmark choice is not that trivial of a decision because we have a bond allocation and we have an international allocation, which makes you deviate from the benchmark by design.
Correct.
And so really what we should use, and we use that too in our performance analysis, we have what's called a strategy benchmark, which is basically our passive portfolio.
Okay.
And
so in other words, were you creating returns better than just being passive?
Yes.
By choosing specific stocks and companies in the other half of the portfolio versus just having been completely passive and putting all in the market.
That's right.
Index funds. Okay.
And that's kind of the idea, right? You create a passive portfolio, see how easy it is, but now that's your benchmark.
Right.
Right. And so now whatever you do, whenever you take money out of that and put it into something else, you have to beat the benchmark. And so that's really, I think, the more appropriate benchmark for us because we do have these two allocations that deviate from the S&P quite a bit. So that's what we use. Yeah.
That's fantastic. And when you think of those allocations and you take something out to, let's say, put it directly into a company, are you doing a weekly kind of comparison, monthly comparisons? Do you do it, was it better just having left that in the S&P 500, for example, versus in Tesla? And then does that also determine whether you should sell that position? How often do you come back to, let's say, quote unquote, rebalance the portfolio?
Yeah, so we usually, so generally speaking, so there are a couple of rules or a couple of constraints that we've set up. So per investment policy, so we have an investment policy statement that is governing the overall approach, and that those constraints are U.S. only, U.S. traded. So we have non-U.S. companies that are traded on U.S. exchanges. That's fine too, but it has to be traded on the U.S. exchange. No position can be more than 5% unless it grows to above 5%. So initial setup of the position cannot exceed 5%. And then we have to be reasonably diversified, but we don't really have to diversify too much because we have this 50% passive index.
Quite
that
diversified.
is a huge diversifier, right?
Sure.
So we don't really have to diversify across our active positions. We've reduced the number of active picks from when I started, we had almost 40 stocks in the portfolio, which is just impossible to monitor. To your second question, which we'll get to in a second. Because these stocks you have to constantly think about, right, and reassess and think about whether you want to buy or sell or hold or whatnot, right? So we've limited. We basically said we're gonna not have a 40 stock portfolio. We're gonna have an anchor of an index fund portion which acts as a diversifier, and then we're gonna make fairly concentrated bets of no more than 15 stocks.
Okay.
So right now we have 11. So we only have 11 positions, and all of those positions are around $500,000.
Okay.
And so when the students propose a position, they have to make a size proposition as well. So not just buy or not, but buy up to the 5% maximum, or less so, which is a reflection of their conviction and the degree to which they can convince the other students in the fund. And so, if they make a very compelling case, we may invest $500,000 in the stock. And I can tell you that the students are getting very intimidated by making a recommendation of that size.
Sure.
If it's like 100,000 or if it's a simulation, it's like, yeah, whatever. But if you bet $500,000 on something I did research on,
you got to have some strong conviction when your portfolio is a $10 million portfolio.
Yes,
right? Yeah.
That's a big position.
Yeah.
And so, anyway, so then basically what happens is it's the class's portfolio. So I tell them, we do whatever you guys bring to the table. So we have them allocated, so everybody owns, or a pair actually owns a stock that's inherited that we have in the portfolio, and they're supposed to monitor that, right? There's listening to earnings calls, they have to keep up with the news, they have to do an ad hoc presentation if something happens to the company, coming back to the class and tell everybody what's going on. And at any moment in time, they can suggest to completely sell everything, or to trim, or to buy more. That's up to the class and to the students that cover the stock. We have a formal check-in in each of the semesters where they present formally, but decision time could be any time.
Okay.
What normally happens is that we build or rebuild the portfolio at the end of the semester, once we've heard everything.
Sure.
Because in most cases, it's like, well, you know, should we sell some, but then what do we buy instead? And let's hear about all the other ideas that are in the works. And so usually what happens is we make most of the decisions at the end of the semester.
So they're presenting the ideas throughout the semester,
Yeah.
and then usually at the end of the semester, the class says, all right, let's take X amount and put it into
Yes.
these companies. Okay,
That's
and
right.
it's just democratic vote, so majority rules.
Majority rules. And it's a fascinating process of group decision making, which you know, you have varying degrees of engagement in the student bodies. You know, you have some people who are very vocal, you have some people who are more quiet.
Sure. But varying degrees of risk tolerance as well,
Varying degrees
right?
of risk tolerance. Exactly. You have you know, some people care a lot about ESG, other students don't care at all, right? And we've had one student 2 years ago who successfully convinced the class to sell Goldman Sachs, for example, which is probably, you know, the premier investment banking organization in the world. But, you know, is always involved a little bit in a scandal here and a scandal there. And so one student made a pitch that, you know, we should not own a company like that. They're too much involved in things that are questionable. And he convinced the class.
Oh,
and we
wow.
sold the position.
Okay.
Again, like, you know, not something I would veto on, but
So really not based on the company fundamentals in terms
No.
of its valuation, et cetera. Just you know, kind of more of an ethics,
Yes.
an ethical standard.
Yes.
Wow, that's incredible.
Yeah.
And do you average cost in, or is it kind of like, boom, we're going to take all 500,000 for this position, or is it kind of, hey, let's go in with a 2% position, see how the company does. So whatever they set, you're just all in.
Yeah, we doubled down on certain positions. Like we doubled down on Tesla, for example, when it came down a lot. But yeah, we don't. You know, one of the challenge with SMFs, with ours and in general, is that the class only owns the portfolio for a year.
Right.
And so it's a very short term. And per design, the class is really not a trading class. It's really an investing class. And so
that's really interesting, because you have this much longer time horizon. So when we're thinking investing, we're thinking of something many, many years out, and versus trading, which could be something that's just held for a very short period of time, day, 2 days, 3 days, a week. But yet your quote unquote portfolio managers are constantly changing. So the investments have a long-term horizon, but the portfolio managers are churning over continuously.
Yes. And so that's exactly right. And so what you end up with, if I think back about how the portfolio transitioned over the last 4 years, because of that, I think we now end up with just the best companies. And this goes back to what we started this conversation with, which is not necessarily the best companies are not necessarily the best investments. But if you have a constant debate around, you know, companies, and you have new people come in, they have to redevelop conviction or not, you end up with the unquestionable powerhouses of our times, which is the Apples, the Facebooks, the Googles, the Teslas, the companies that everybody knows because they are so well positioned, they produce so much profits, they're so competitively, you know, well situated that it's almost like, you know, what can you argue? It's only about what's priced in at that point.
Sure. So the sterling quality companies,
Yes.
companies that I say are like the high quality giants of the industry.
Yes.
Sure.
Yeah.
And so I presume that you all have had the opportunity to see kind of that rise in meme stocks, and has anyone come to the table and said, hey, we need to buy GameStop and put like 500,000 in it like now?
No.
Okay. All right. So you've taught them about, you know, trend following versus actual investing.
Yes, we can quickly kill that attempt by just, you know, reinforcing the point we're investing and not trading.
That's fantastic. And what are some of the core principles that you hope to teach your students while they're participating in this unique and quite amazing opportunity?
Yeah, so, you know, back to my PPPPP title, right? So
Yes.
I'm a non-academic, and I think Trinity has done a really awesome job in creating these positions, which they call professional practice, which are professor positions that are held by non-academics, but people with practitioner experience or practice experience. And so I see my job as getting the kids, I call them kids affectionately, the kids ready to be successful, right, in the workplace. And you know, it's not about stock picking and beating the market, really. I mean, that's one of the objectives, because how can it not be if you invest money, right, in an active way? It has to be you have to beat the benchmark. Why else are you doing it? But the learning outcomes are really much broader than that. I think students need to learn how to write and how to present and how to package their package and present their ideas. Right, that's at the core of what they do. And so when we look at this equity valuation class where they do research on a company for the first time, and they also have to present twice during the semester and before the midterm and then before at the end about their company, to all the way at the end when they do SMF2, the last presentations, I mean, that progression is just amazing to see. I mean, at the end of before they graduate, they can talk about a company for an hour.
Wow.
In front of the class, well-researched, substantiated, covering everything. The company, the industry, the competitive positioning,
management,
the financials, management, valuation, everything, right? And they can talk freely, they can talk, you know, in a convincing, more or less convincing manner. They create good-looking slides, you know. I tell them all the time, you know, if you have the best thoughts, but you don't present them in a visually appealing way, people disconnect, right? Or if you write a report and it has 3 typos on the first paragraph, nobody believes what you have to say, because
Sure.
you're just considered to be, you know, not engaged enough to create a document without typos. How can your thoughts be clear if you can't write? And so, you know, there's all these things, right? Which is like, well, how do you have a good debate? How do you bring in other people's opinion? How do you, so there's so many things that this class allows you to train and practice, which is why it's so great, I think. And, you know, picking stocks is just a little sliver of it. But it's really about how do I mean, there's business students, right, and finance majors at the end of the day. So how do you think about the business? How do you talk about the business? How do you analyze it, value it, compare it? All of these things are coming into play.
So I don't know if you knew or not, but I was one of the early student managed fund students. And so at that time, I remember that it was groundbreaking, because there weren't that many universities that were actually dedicating a portion of their endowment to have students management.
Yes.
Or to have students manage that portfolio. And now it's just incredible to see where it's gone. I mean, from when we started around the 500,000 mark to 10 million is just incredible. And on the show, generally I don't invite guests here to come and talk about performance, because performance, you know, it's historically based. And so there's, the show isn't about performance and how you did, but it always begs the question we have to ask. So are your positions generally beating the passive index? Do you find that the active positions are over time outperforming the passive index, and over time could be, let's say, a year or longer, right? I mean, this last year was also a great indication of what happens to the downside when the markets start falling or capitulating a lot of those gains.
Yeah.
So, you know, what's your observance of that in the student managed fund, without really getting into the numbers? We don't have to talk about the actual performance, but just relatively, what have you seen the student stock picking selection, active versus passive? Who's winning?
Well, it's a little bit different every year. Okay, so we have when I first started taking over, we had a long conversation with the investment committee, which is basically our boss, right? The Trinity's board of trustees as a subcommittee, the investment committee, they oversee the endowment.
Okay.
And the endowment is run by a gentleman by the name of Craig Crow, who's great. And we had a lot of conversations about what we should be doing differently, if anything, from relative to the previous regime, right, if you want. And one of the things that the previous regime did was they had the very big portfolio, the 30 plus stocks, and a significant portion of cash. Mm-hmm. And when you look back to the presentations to the investment committee each year, which is kind of the annual performance review, if you want, there was always a lot of emphasis put on the fact that we're about to enter into a big downturn, right? And as the saying goes, you know, even a broken clock is right twice a day, something like that.
Sure. Yes.
And you know, the fund was lagging significantly because, as you remember, over the last 10-ish years, everybody constantly talked about the fact that next year is going to be a bad year, and it happened once in 18 or something like that.
Despite such a run in the FANG stocks, for example.
That's right. And then we had yield curves that were reversed, and all these recession indicators were around all the time, right? And
yes.
so one of the things we decided is like we want to be constantly invested, right? No cash anymore. Which was a fundamental decision just in terms of the investment strategy.
Sure. And the allocation, correct.
Yeah, exactly. That's what led to the three fund portfolio, the passive position, and we did that change. We implemented that change. We made the decision in February of 2020, which was pre-COVID, and then we dollar cost averaged in over 6 months.
Okay.
And we actually went in through the COVID crash.
That's ideal.
Which was amazing, right? So our first year was out of the park great, but it was an allocation thing, not a selection. So if you, for the viewers, if you analyze portfolio performance, you can distinguish your excess performance or lack thereof between selection and allocation. Allocation basically means what weights do you put on the market versus maybe foreign versus domestic, or bonds versus stock.
Sure.
And then selection basically means, can you pick the right stocks?
Correct.
And
that's great.
We have, if you look at the last couple of years or any years, you always have a mixed bag. Sometimes you're better off because of allocation or worse off because of allocation, depending on what the market does. If you have a fixed income allocation in your portfolio and the market does well, you're lagging.
Right.
Just because of that. Right?
Sure.
So we tend to, when we look at the results, with the exception of last year, 2022, where we did not well at all, we tend to have a positive selection effect, which means that our stock picks tend to be good picks. But we're talking about a point or two, not like 5 or 10.
Sure.
So fairly small. And from an academic point of view, I would say that it is mostly associated with luck, I would say, at the end of the day, whether you pick the right ones or not. I mean, even Tesla, which is, again, from a company perspective, such a well-positioned company, depending on which time frame you measure the stock performance in, whether it's 20 or 21 or 22, you get vastly different results.
Sure,
right? And,
absolutely.
It's just very hard to generalize the results that are measured on an annual basis even.
Well, I tend to be both fundamental as well as technical. So in my practice, I try. I can't say that I time the market, because timing the market, I don't have an algorithm for it, and I can't say that I've ever been successful in actually timing the market. If I get it, it's because of luck. It just happened to be, the right opportunity when the market decided that there was some buy pressure, and I caught it at the right time. It went back up, right?
Right.
But I do believe, you mentioned, the cyclicality of stocks. They go up, they come down in certain years, but the asset classes that you're in, I think most advisors will say it's really the asset classes and your allocation to those asset classes over time that generate meaningful returns.
Yes.
But the fun part though is always, can you pick the companies that are going to be the winners, and that's where the fun comes in.
Yes.
So it sounds like you're giving the students the opportunity to do both. And in our discussion, you actually helped answer, indirectly or just voluntarily, you answered questions for our audience, such as, what's the difference between passive and active investing? I was going to ask you about that, and we've had a great discussion about that. Great discussion about, just how to think about the fundamentals when evaluating companies. And it's just incredible that you're giving students this opportunity to implement and practice that before they actually get into real investment world jobs where they're having to make those decisions on the regular basis. And so you've provided tremendous insight. I do have one question for you. It's kind of my capstone question, because the minute someone finds out that I'm in private wealth management, the first question they want to know is, what is the market going to do this year? So, Karl, what is the market going to do this year?
Well, I mean, I'm of the firm belief that on average the market is going up, and along the way it's going to go up and down. So, and we don't know more than that. That's kind of my thinking, which is like, you want to be in equities in the long term. You want to have a significant allocation, to your point, to equities, including a global allocation, because the world is very US centric, but there are other parts of the world too, and they don't work in lockstep, so that provides additional benefits, diversification benefits. So you want to have a significant exposure to equities in general, because in the long term, if you think yourself as a long-term investor, you will benefit that. And to your point, asset allocation is 80% of the results. So you want to have that. The way that I explain, or the way that I'm trying to articulate the value of bonds, which we know they're more stable, supposedly weren't last year.
That's right. They still fell.
Is that you need to have enough bonds so that you can stomach the swings.
I see. So it's just help weather some of that volatility.
Because it's all psychological, right? If you want to have a big equity exposure, you want to be able to not sell when the market goes down, because every now and then it does, like it did last year, right? So if you sell in a down market, that's really bad. And so the bonds help you to lower or to smooth out some of these swings, which probably takes the temptation away, or ideally removes the temptation to sell in a downturn and to really move through the swings. But in the long term, you want to be exposed to the market because it's going to go up.
That's fantastic. Well, Karl, thank you so much for spending your morning with me.
Thank you.
For being my very first guest on my show on Vok Talk. And
I'm honored.
Yeah, I'm honored as well. I really appreciate your insight, and we're just so excited to have you at Trinity. I think you've just been a tremendous asset to Trinity University. Great mentor for the students there, and thank you for the work that you're doing.
Thank you very much.
Yeah,
Appreciate it.
Thank you all for our first episode of Vok Talk, and we will be back soon. Yeah. Hey, man.
Well done.
You too. Thank you, senor.